Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
Hello there, Real Estate Cowboys. This is John Larson, your host. This week's episode, we're going to start with a Texas market report, talking about some things going on in the Texas economy, some new developments, and just an overall update on the market. We're also going to be talking about 7 things to consider when looking to purchase or invest in a single-family cash-producing property. So a lot of cool stuff to talk about today. But let's start with the market update. Going right into some things in the news. Not surprising at all. Just saw DFW led the country in employment growth with almost 120,000 new jobs added this past year. That even beat out New York. New York was second with 113,500 new jobs. And that's according to the Bureau of Labor Statistics. And so at that pace, DFW is adding about 330 jobs per day, which is just, it's crazy. At the end of the first quarter in 2017, more than 32,000 apartments were being built in North Texas, the most of any U.S. market. And that should just coincide, I guess, with obviously the large amount of population growth that we've been experiencing in the North Texas area and just in Texas in general. DFW led the nation again in new transplants. Almost 150,000 new people moved to the market last year, which is great for investors, right? Especially investors who want to invest in cash-producing properties. Obviously, your property is not going to perform for you unless you have someone willing to rent it from you and live in it and pay you rent. And so that's why I love the Texas market and all these markets in Texas, but Dallas, Fort Worth, and Houston specifically, because it's very easy to rent your property out. It's very easy to keep the property occupied. It's very easy to keep that property cash flowing and cash producing, which is why I go back to my investors quite often. And, we have conversations over the phone or in person where they're talking about, well, I could get $100 more in cash flow here in this market that's not growing, it's stagnant, or it's losing people. And I'm thinking to myself, what is that $100 extra cash flow going to do for you then if you're just buying in a more risky market or in a market that's not growing like some of these other markets around America, DFW being one of them? That $100 cash flow isn't really going to matter, that extra $100, if you can't keep the property leased consistently. So investors, when you're thinking and choosing about markets, or when you're choosing a market to invest in, you have to consider that. You have to consider, what does the growth look like in this market? Are there more people leaving this market than moving in? Is there not very much population growth? Is it just kind of stagnant? And when you're running your numbers, you have to think about these different variables. Real estate investing, I say this quite often, it is not black and white. There are a lot of different variables that go into it. If we all made our decision on purchasing investment properties just based on the black and white numbers on a spreadsheet, you'd see a lot of failures out there. I just talked to a client yesterday on the phone. This poor woman. She bought 5 or 6 homes in Indianapolis from a provider up there that looks like he's going out of business. His property management company's gone completely radio silent. This is a guy that was on television. This is a guy that was putting together videos talking about $40,000 assets. They're good properties. They're good investments. You can buy $40,000 homes in good areas. I mean, it's just these videos were comical to me. And I thought to myself, this guy's going to be out of business very soon, peddling this type of investment property. I have friends that I'd call them slumlords, right? In Detroit, and they own 20, 30, 40 homes, but they manage them themselves. It's their job. They build relationships with the tenants. They file the paperwork with Section 8. They make sure that their properties are up to code. When someone doesn't pay rent, they're going down and knocking on the door. You might be able to get those properties to perform if you're actively managing your portfolio. But investors that are looking for a passive solution and want to, hire a third-party management group to manage their 5 to 10, whatever, how many homes that are 40, 50, $60,000 in distressed areas across the US and these major metros, they're very, very hard to manage. They're very, very hard to keep under control. They're very hard to keep performing. And so if you want to hire a property management company that's managing hundreds of doors that are in that C and D class range, you're going to have a very tough time having a passive experience. Trust me. If you're managing them yourselves and that's your job, I think you can get those properties to work. You can get them to work pretty well. But if you're out in California and you're investing in Detroit or Indianapolis or Cleveland, you're buying C or D class homes, do not expect a passive experience. Okay. And so, I feel bad for these investors that trusted this company out in Indianapolis. There was another company out in Chicago, I think it was a year or two, that just went under. And I know a lot of investors personally who were affected by them going under. And so now it looks like the same thing's happening in Indianapolis with guys that are peddling C and D class properties. It's just, that's the nature of this business. You are not going to get a passive experience investing in properties like that. I'm telling you right now. So back to the market report. We got another development announcement as well that's going on here in Dallas, in downtown Dallas. There's a Dallas-based real estate development private equity firm that's spending a substantial amount of money to create a new district inside downtown Dallas. It's Todd Interest, and they announced on this past Thursday, that they will be creating something called the East Quarter. And it's going to be a 20-acre project encompassing 200,000 square feet of office, restaurant, and retail space across 18 buildings. That's just another big announcement here, and it's big news for downtown Dallas. I see a lot of money going into revitalizing downtown Dallas, and it's a great sign. But I attribute that to the millennials that are moving into the market, the young business professionals that are moving in daily that want to live close to downtown. And so you see there's a lot of money going back into the downtown area, which is really, really great to see. So USA Today read an article. They had their 10 states that they predicted to have the strongest housing markets in 2018. Number one was Nevada, and that one actually is in question to me. I see there's a lot of growth in Nevada, but there's not really an economy to back that growth. You don't see increasing wages. You don't see a strong economy to back all this housing boom that's going on there. So that one's a little bit concerning to me, but I can see why Nevada would be number one on there. There are a lot of new homes being built, and there's a lot of migration into that area as well. Number two is Texas, and obviously that's because of the booming economy that we're experiencing here in the Texas market. I could definitely understand why Texas would be on that list. I was actually surprised to see that they were not number one, but number two is still a strong position. Number three is Florida. Number four is California. 5, Utah. 6, North Carolina. 7, Colorado. 8, Tennessee. 9, Oklahoma. And 10 was Georgia. And so investors listening to this show, if you don't think Texas works for you for whatever reason, definitely you should be looking at some of these other markets. Now, California, not so sure for cash producing property. The values there are quite high. That's why you see so many California investors investing outside of the state of California, because it's very hard to find good properties and good neighborhoods in California, and where the numbers make sense, where you can get positive cash flow. So, but I'm sure, I know that the California market is booming in terms of appreciation and property prices that are rising rapidly. But for our model and for passive income investing, doesn't really make sense. Same goes for probably Colorado, Denver, the Denver area. I know I have a lot of investors that invest with us outside of that are located in the Denver market, just because the prices have gone up so greatly there as well, where it's very, very difficult to get homes in good neighborhoods that produce positive income. So going back into the Dallas report here, this is some housing statistics. The median sales price in the Dallas-Fort Worth Arlington market have skyrocketed 33% in just 3 years, so an average of 11% per year, which is outstanding. And I have seen that with my own properties. They have increased in value quite considerably in the years that I've owned my homes. And so sitting on quite a bit of equity growth, and obviously that equity doesn't make any. It's not doing anything for me right now until I make it tangible. So I am looking at potentially doing some refinancing here in the near future, where I could pull some of that equity out of these properties and reinvest it into some more homes potentially. I'm looking at some other markets as well outside of Texas. I'm also looking at some secondary markets here in Texas that I think have a strong opportunity moving forward in the coming years. One being Waco. I really like the Waco market just because of the proximity where it's located here in Texas. It's in between DFW and Austin. So I feel like there's some good opportunities in Waco. And I feel like as property values start to increase in price in markets like Dallas, Fort Worth, and Houston, and Austin, which Austin has already rose pretty high to the point where it makes it very difficult to find cash producing properties in good neighborhoods, even in Austin. But you look at Waco, where it's positioned right in between Dallas and Austin. So as real estate prices increase, they're going to increase for businesses as well. And businesses still want to move to Texas because Texas is pro growth and pro business, but it might not make sense to be in the Dallas market in the coming years or in the Austin market. So maybe they would look to, I feel like they're going to start looking to areas like Waco just because where it is logistically, and they'll probably be able to get more affordable land or more affordable buildings in the Waco market. So that's one that I definitely have my eye on. Also, the Texas market report that came out from the Texas A&M Real Estate Center, they put this out every quarter. They showed from the first quarter of last year in 2017 to the first quarter of this year in 2018, the median price in Waco rose 9.4%. It's almost 10% in that market. It's pretty crazy. So we're seeing a lot of appreciation in markets like Waco right now, also in Lubbock. These are college towns. They're not as large of cities as obviously, Dallas, Houston, Austin, San Antonio, but they're coming up. They definitely are. When you talk about the growth that Texas is experiencing, it's just going to happen organically that these other smaller cities in Texas are going to grow as well. And so I know there's a lot of investors out there that are talking about is the Dallas market overpriced, there's no cash flow in Dallas, so on and so forth. Well, there's cash flow in these other areas, these secondary markets that I feel will continue to grow rapidly as more and more jobs are injected into the Texas market and more people are injected because of those jobs. So it just makes sense that some of these secondary markets are going to grow as well. Now we're going to go into back into the market report. I have a report here from Robert Kaplan, who's the president of the Federal Reserve Bank in Dallas. And in a recent interview with the Houston Chronicle, he said the number of people living in Texas has grown from 22.5 million about a decade ago to more than 28 million and could rise above 40 million over the next quarter century. That is just amazing. That is the growth projection that Texas is on right now. So investors, if you are not looking to invest in Texas, you really should be. You're talking about an unbelievable amount of growth. They're talking about 12 million more people are expected to move into the Texas market over the next 25 years. It's just amazing. And just the growth itself of 6 million people, almost 6 million people just over the past decade have moved into the Texas market. So it's definitely something that you should keep your eye on if you are not currently. The rise in oil prices. The U.S. crude settled at $72.13 at the end of May. That's almost 3 times higher than it was 2 years ago and the worst oil bust that we had ever experienced. And you would think, Texas 30 years ago would be extremely depressed by something like that. But it just shows you the resilience of Texas and the diverse economy that we have in Texas today, that this oil bust did not cripple the Texas economy. People continue to move here. Jobs continue to move into the Texas market. The housing prices continue to increase. Rental rates continue to increase. Unemployment continued to decrease. And wages continue to increase. So that to me, if I'm an investor, I want to see a resilient market, and Texas is definitely a resilient market. I mean, projected and predicted. Economists are predicting that we are going to run into another recession here in 2020, and they're saying this because the baby boomers are more and more are starting to retire, and by 2020, the majority of the baby boomers will be retired. And that is worrying economists because they feel like the workforce is going to be decreased by 2020, which is going to have a negative effect on the economy. Although millennials have become the largest population group in the U.S., the baby boomers are still, many of them are working today. And they are expecting in the next 2 years that majority of them will be in that retirement age or past the retirement age. And so we are going to have issues with labor in the U.S. And so for me, as an investor, investing in cash producing properties, investing in some of these markets across the U.S., if we're going to be going into a recession in 2020, I want to make sure I'm putting my marketing dollars, my investment dollars into a market that I know is going to be able to withstand another recession. And, coming from the city of Detroit, coming from the Midwest, I see that the Midwest, in most cases, when we go through a depression or recession, is really negatively affected, and it really gets hurt by downturns in the economy. But in Texas and DFW specifically, where you have the most corporate headquarters in America, and more keep coming, I don't expect the Dallas-Fort Worth market to be too affected by a downturn like this or another recession. There's plenty of people here that are, millennials or that are at that working age. So I don't feel like we're going to be too affected like that, which is another reason why I feel very comfortable and safe having my dollars invested in the DFW market and other Texas markets here in Texas. Waco and Lubbock are ones that are definitely on my radar for me to get more affordable housing and better cash flow and better rate of return on my rental income. And also it shows, just from the Texas market report, increases in pricing as well, and that appreciation and equity growth that I'm looking for in markets that I want to invest in. So we're going to take a quick break here. We are talking about the Texas market report, talking about new developments, talking about the housing market here in Texas, talking about the economy here in Texas. When we get back, we'll talk a little bit more about that, and then I'm also going to talk about 7 things to consider when purchasing or investing in cash-producing properties. So, Real Estate Cowboys community, we'll be right back.
Did you know there are 6 different ways real estate pays investors? Are you interested in getting started with real estate investing but just don't know how? Investing in real estate can be challenging, especially if you don't have the time, experience, or resources to do so. At American Real Estate Investments, they do all the hard work for you. They're a DFW-based company that buys homes in great neighborhoods, professionally renovates them, and places business professional tenants in your property. With their program, you can start earning headache-free passive income and equity growth from appreciating values in the fast-growing DFW market. There is no better place in America to invest in real estate today. To learn more about how their investors are earning up to 100% returns or greater with their program, give them a call at 888-323-AREI or visit their website at areiusa.com. That's 888-323-AREI or areiusa.com.
Okay, Real Estate Cowboys, we are back. This is John Larson, your host. We're talking about the Texas market right now. We're giving a Texas market update on the economy, update on the housing market, and update on some new developments and new news that's going on in the Texas market. So another article that I just read was the new Fortune 500 list came out, and 22 Dallas-Fort Worth companies made the 2018 list. That is awesome news. 24 in Houston, 22 in DFW. I believe Texas now ranks number 2 in the country, just behind New York for the most Fortune 500 headquarters. And I think one day it might take over the top spot, the pace that it's on, and just the pro-business state that it is, and the more affordable market that it is. And so that was great to see 22 DFW companies make the 2018 list. And for those of you that don't know, I say this a lot, DFW is actually home to the most corporate headquarters in America. So lots of jobs here. And with all the talk about a new recession, an upcoming recession here in 2020, if you're investing in real estate, I think that it's a safe bet to stick some dollars here in Texas and DFW and Houston and well, more so DFW specifically. I just feel like it's a very, very safe, stable market right now with tons of job growth, tons of job opportunity, which is resulting in a lot of population growth and a very strong workforce here in Dallas-Fort Worth. Another development, potential development that I've heard about, and another business that's moving in, creating jobs, Simpress, which there's a subsidiary of their company, Vistaprint, may be bringing more than 600 full-time jobs to Dallas County, and specifically South Dallas County, which would help boost the local economy, obviously. And they may invest up to $50 million to build a 322,000 square foot manufacturing facility, like I said, in South Dallas. So that's some big news. The project report claims the facility would bring more than 625 full-time jobs to the area, either as new or relocated positions, and it would add 125 seasonal jobs by 2023. Not only that, it is reported that the overall median wage for full-time workers would be $40,000. So just slightly below what the median income is here in the Dallas area, but really good to see that you're bringing in, we're bringing in, it looks to be over 600 more full-time jobs to the area. So that's just something that I saw was recent news. Now, let's talk a little bit about Houston. The Houston metropolitan area added jobs for the 7th consecutive month in April, catching up to the state's employment growth rate as higher oil prices provide a lift to the local economy. So, Houston was doing pretty well, even with oil prices going down. And now that oil prices are rising again, it's just going to make Houston's economy even more of a juggernaut. And so you see that it is, for the 7th consecutive month, adding jobs. Me as an investor, that is what I want to look for in a market. And so really, really good news coming out of Houston. Houston actually added 12,000 jobs in April after adding just under 12,000 in March and nearly 13,000 in February. The Texas Workforce Commission reported Friday. That's big news. Over the past year, the region gained more than 80,000 jobs, matching the state's job growth for about 2.7%. and easily exceeding the national employment growth rate of 1.6%. So going ahead of the nation, setting the trends here in Texas. Big, big news. Houston recently lagged the state's economic and employment growth in recent years because of its greater exposure to the oil and gas industry, which suffered a 2-year oil bust, and it was considered the worst in 30 years. As the industry and crude prices have recovered, so have the local economy. There are now more than 1,000 rigs operating in Texas and the U.S., and that's the highest level since 2015. And that information came from the Houston Oilfield Services Company, Baker Hughes, and that was reported just this past Friday. Okay, so let's go into the second part of the show. We're going to be talking about 7 things to consider when investing in cash flowing properties. Number 1 on my list, for me, when I'm looking to invest in a market, is I'm going to look for appreciation or capital growth in the market. And so I like to look for markets with high population growth. Obviously, the population growth is going to drive up the prices of real estate in any market due to the high demand and low inventory. It's simple economics, supply and demand. If there's more demand for property in a certain market than there is supply, it's going to cause increases in pricing. So that's why I like to look for markets like Dallas-Fort Worth, or there's other markets across the U.S. that are experiencing very high population growth as well. Denver, but not all the markets make sense with the numbers. So we'll go into that a little bit further as we go through the 7 things to consider. But number 1 for sure is going to be the appreciation, capital growth, and population growth. I also like to look for job growth in the cities where I'm looking to invest. Research the Fortune 500 companies that are moving into your market. Look for the amount of Fortune 500 companies there, Fortune 500 companies, or Fortune 1000 companies there. And so, like talking about Dallas, leading the country in corporate headquarters, tons of jobs, 2,200 Fortune 500 companies. I believe they have over 40 Fortune 1000 companies. So that's a really good market to identify for appreciation and capital growth. And obviously, as more people move into the area, the real estate market begins to adjust. And the adjustment can take a few years. But as an investor, you want to be part of the market from the get-go so your investment can blossom with the growth that just blossom alongside that growth. And so a lot of my investors who started working with us back in 2012, 13, 14 are reaping a lot of benefits of that growth. I mean, many of my investors right now are refinancing their properties and pulling out tens of thousands of dollars in equity. Some of my investors that purchased from me back in 2012 and 13 some of them have $100,000 in equity in their property because they purchased it early on, coming out of the recession, when property values were still low here in the Dallas area. And because of all the population growth and job growth that we've experienced here in the past 6 years, 7 years, basically past decade, have attributed to that growth, and that's why they're sitting on a gold mine right now. So kudos to them for jumping in on the market early. I still think there's an opportunity here for growth. I don't think that it's too late to invest in a market like Dallas or Houston, but these are the markets where you're seeing the great appreciation and still are able to get in on a property at an affordable price. Number two is obviously everyone's favorite, it seems like, cash flow, which, as we talked about last week with Keith Weinhold, cash flow is just one of the ways that these properties pay you. There's up to 6 ways that you can make money off of real estate investing and buying single-family homes specifically and being a landlord. But cash flow is important. But once again, we caution our investors to not be fooled by paper yields. And what I call a paper yield is an Excel document, right? Once again, real estate investing is not black and white. You cannot make your investment decisions solely on the rate of return from the rental income that the property is going to produce, okay? In today's market, with the rising prices and the rising interest rates, you are only going to see high cash flow numbers on properties that are going to be a lower value, which means they're in a more distressed area of these major metros, or they are in a metro in the U.S. that is not thriving. Okay, it is not growing. It is stagnant. It has always been a cheap area to live in. It will continue to be a cheap area to live in. Okay, so you need to be very, very cautious about that, and also understand that many of these properties that have the high rate of return, it's a high risk, high reward scenario. And a lot of the success of your property is going to depend on your property manager, which in my experience, C-class properties generate C-class property management companies who aren't the best. It is very, very difficult to manage these homes and to achieve the returns year over year that you are looking for from investing in this property. So be very, very, very cautious of that. Like I said, high return is always going to be associated with high risk. It doesn't matter if it's a stock. It doesn't matter if it's a oil and gas opportunity. It doesn't matter if it's a single-family home. If it is a more risky investment, it obviously will show a higher rate of return, but all the stars really need to align to see that return. So, like I said, be cautious of that. But cash flow is important. We want to make sure that our properties are going to cash flow. I at least want to see that my investments are going to break even. I want to make sure that the rental income is going to take care of all the expenses and also take care of my loan amount, my loan payment. And keep in mind that your principal payment is not an expense. Your tenant is paying down your principal balance for you. It should not be viewed as an expense. Okay? So I always look at my principal amount that's being paid on my loan as profit. Right? I factor that into my cash flow. I don't look at it as an expense. The interest payment is an expense. The principal pay down is not an expense, in my opinion. With higher cash flow properties, there's going to be a lot of times less room for capital growth with those properties because you're probably buying a high cash flow property, like I said, in a more distressed neighborhood where you don't have a lot of owner occupants buying in those neighborhoods, which are going to drive up the cost of pricing in those neighborhoods or the cost of the property in those neighborhoods. You're buying in a neighborhood that's primarily properties that are investor owned. They're being traded on cap rates. They're not really increasing in value. So, like I said, if you're looking for strictly cash flow properties, the chance for appreciation is not going to be as common, and it's also going to be a lot more volatile. So, we go through another recession here in 2020, you better expect your properties in Detroit and Cleveland and Memphis and some of these other areas in the Midwest, they are going to devalue because of this. Now you look at other strong markets in America that have a lot of jobs, have a diverse economy. I don't expect a recession to affect those prices too much. My personal philosophy with these properties, and when it comes to cash flow and things like that, with locking in long-term fixed debt, if you're not losing money each month on the investment, in my opinion, you're winning. You have, like I said, a tenant in there that's paying down your principal balance. He's paying down your loan. He or she is paying down your loan for you. And you're holding an asset that you have tons of tax write-offs available to you year over year. It just makes sense. So cash flow is important, but it should not be your only, it should not be the only factor in your decision on what's a good property, what's a good investment. Number 3 I have is tenant profile. And the tenant profile consideration is pretty simple. Lower grade properties are going to attract a less reliable tenant when meeting rent obligations, whereas higher grade properties in better areas and neighborhoods are going to attract a more reliable tenant who can commit to long term, who can consistently pay their rent. You don't have to worry about evicting. Evictions, it's proven, they're a lot less common with higher priced properties that are located in neighborhoods that are very close or at the median value for that market. I say this a lot: when you deviate too far below the median value in any market, your risk is going to greatly increase, and a lot of that is due to the fact that the tenant profile in those neighborhoods is not going to be as strong as it would in a higher end neighborhood. Those people just do not have as good of jobs, consistent income, and a car breaking down or job loss can really affect their financial situation, and a lot of times it will result in an eviction. And now you have to deal with the turnover, you have to deal with an extended vacancy, and now, if you have own your property in a distressed neighborhood, your property's vacant, you're now leaving it open to break-ins and thefts and vandalism and so on and so forth. Number 4 I have in here, vacancy. You have to consider vacancy in any market that you are analyzing, and different markets have different levels of vacancy. A Detroit market doesn't have 150,000 people moving into the market year over year. I don't know what the population growth looks like in Detroit, but I'm sure it's not very, very high. So if you're looking to invest in a market like Detroit or Cleveland or one of these areas in the Midwest, Indianapolis, I would definitely assume more for vacancy, because if your property goes vacant in the middle of winter, there is a good chance that you could experience an extended vacancy with that property. When analyzing an A-class property in a growing market, a fast-growing market like a Dallas or any of these markets here in Texas, I would account for far less for vacancy and understand that the risk for vacancy is going to be a lot less, because you have, I just showed the stat earlier in the show, almost 6 million people moved to Texas in the past decade. So that, to me, tells me that vacancy is very low in markets in Texas. So be very, very cautious about what your assumptions are when analyzing a market, because you could assume yourself out of a deal. If you're running the same vacancy numbers for Detroit or Cleveland that you are for Dallas or Houston, you're probably going to talk yourself out of a good investment opportunity. So just be cautious of that. Number 5 I have as rehab quality, and also I will add in maintenance. And you want to make sure you're purchasing an investment property that has gone through a quality renovation and has been inspected by a third-party inspection company to make sure that you're buying a truly turnkey asset. And a home that is poorly renovated, or a home that is older, or a home that is in an area with maybe not as good of a tenant profile, where you might have some tenants who are a lot more dirty and might beat up on the home a little bit more, you're going to run into a lot more maintenance issues. So you need to factor that into your return as well. You have to think about that stuff. C and D class properties have a lot of maintenance on them. All right, it's just a proven fact. I've done thousands of properties, and I've done these properties in many markets across America, and one thing I can say is the properties that were in that C and D class and low B class even price point, they had a lot of maintenance on them, quite considerably more than what I experience in my high B to A class properties. It just seems as those tenants take better care of the houses. They're cleaner. They try and keep a good home. Even though they're renting a property, they still treat it like they own it. So that will really have a positive effect on your numbers when it comes to assuming cost for maintenance and capital expenditures. Number 6, we talk about this a lot, is property management. That I believe is the most important thing to consider when investing out of state and not managing the properties yourselves. Like I said earlier, I have friends in Detroit that I would consider them slumlords. They own, low C to D class properties, but the properties perform pretty well for them, but it's because they manage them themselves. They don't live in California and invest in C and D class properties in Detroit and leave their financial future up to a third party property management company. Okay, they control their own future. They control the money coming in. They control the investment themselves. And when doing that, you can have a good experience in buying these lower grade properties, but now that has become your job. That is no longer passive. Okay, and this show is primarily about passive income real estate investing and leveraging good teams and making sure that these teams are going to be able to get you the returns that you're looking for. But I'm telling you right now, it's very, very difficult to manage these lower grade properties. And so if you're not doing it yourself and you don't care about them, like no one is going to care about your investments like you do. Okay, nobody. So if you're putting your financial future in the hands of a property manager, it's a lot of trust that you're giving these people. And so, like I said, the only way that I can really look at my clients in the face and ensure that they're going to have a passive experience, you're going to have to buy a higher priced property. And you're going to have to buy it in the right market. Because I need to be able to put in good tenants consistently in your home. I need to be able to keep your property rented out consistently. When the property goes vacant, I need to be in a market that I know I can rent the property out very quickly for you so you don't have a long-term vacancy. I need to make sure that I'm putting good tenants in the property consistently that are taking care of your property and paying you rent consistently. I need to put you in properties and in markets where I know, and in areas and neighborhoods where I know evictions are not going to be very common, right? Because of the type of tenants that I'm placing in these homes. This is all stuff that needs to be considered when investing in these properties. Okay. Do not base your decision on a good investment by the cash flow strictly. That is not a good way to look at investing in single family homes. And number 7, exit strategy. Once again, also very important, and this goes back to the A, B, and C class properties as well. C class properties, not a lot of different buyers that are looking for those. Investors like C class properties, sure, you might be able to sell the property to another investor. Are you going to be able to flip the home on the MLS, hire a real estate agent, and get top of market value, retail value for your property by selling it to a homeowner? Probably not. Or your likelihood of doing so is going to be far less than buying a property at high B to A class property in a good neighborhood, in a market where a lot of new people are moving in daily because the demand for property is going to be extremely higher there, right? Going back to Detroit where I'm from, I would start off as a retail real estate agent, and in the winter, there was not a lot of movement in the real estate market. In the summer, sure, the market was really hot. But let's say you need to exit out of your property in the middle of winter. You're not going to have as many buyers in that market. You're just not. And let's be honest, people. Life happens. Okay. Just because today you have a bunch of money to invest in real estate doesn't mean 5 to 10 years from now you are going to be in the same financial position. Hopefully you're in a greater financial position, but life happens. What happens if you need to exit out of these homes? What happens if you need to sell one of these homes? What happens if you need to pull your money out of these investments? Don't you want to make sure that you're investing in homes that you can easily exit out of? Don't you want to make sure that you can sell these properties at the top of market value, that the buyer's not going to care what the capitalization rate on the property is? The buyer's not going to care how much the property rents for. The buyer just wants to move in there with their family because the home's in a good neighborhood, it's in a good school district, it's in a neighborhood where retail buyers want to buy, and that retail buyer is going to pay you market value for that home, not want a discount, not want to cut you out from under your legs and buy the property on a deal because they're buying it as an investment, and only investors are looking at buying in those markets because this is a 90 to 100% rental occupied neighborhood. There are no owner occupants, or if there are, there's very, very few. So that's another thing that you want to consider. It's a very, very important thing to consider when investing in rental properties. What if I need to exit out of this home? Am I going to easily be able to exit out of it? I know a lot of investors that want to exit out of their properties because they didn't have a good experience. They went and bought C and D class properties. They were sold on a dream, and the property did not perform the way that they expected. And now they're sitting here holding the house, and it's vacant, and it's costing them money, and they want to sell it so bad, but the only people that they can get to buy it is somebody that's going to offer them $10, $20, $30,000 less than what it's worth, because they know that they're in a distressed situation, and they know that the property is in an area where it's just strictly properties being traded on cap rate from investor to investor, and there are no retail buyers there that are going to come in and say, hey, I'll pay you what that house is worth because I want to move my family into this area. So be very, very cautious about this. Consider these 7 things anytime you're looking at investing in a single family home anywhere in the U.S., a rental property. And I hope that we were able to give you all some good information today. This is John Larson with the Real Estate Cowboys. If you like what you heard on the show, please subscribe to us. Podcast comes out every Sunday. It's on all the major platforms out there. My go-to is iTunes. I'm an iPhone user, so I get all my podcast updates as they become available. If you like what you heard, please go to the Real Estate Cowboys, DFW.com, put in your information, and receive our passive income starter kit. This starter package talks about all the different passive income options that are available to investors, single-family rental properties, private lending opportunities specifically for my IRA, 401k crowd. If you have not self-directed your funds yet, you should definitely look at doing so. Private lending is a great, great option to get a high fixed rate of return on your money, and a consistent passive income stream back into your retirement account that's tax-free or tax-deferred. Also, vacation properties in Belize. We talk a lot about our private island developments there and our luxury vacation homes that you can use when you want, and when you don't use it, we rent them out for you and professionally manage those properties for you as well. So great information in that passive income starter kit. Also, my passive income guide will be coming out here shortly. That's great for new and seasoned investors to read about all the different options that are available to you. I talk about the 7 things to consider when investing in real estate. A lot of the stuff that I talk about on the podcast is also available to you in that book. So that will be out shortly. Hopefully within the next month here, you'll be able to get that from Real Estate Cowboys, DFW.com. Also, when you sign up, you'll be able to get access to exclusive passive income real estate opportunities. You'll be able to see single-family opportunities that you can invest in, new private money lending opportunities that are available in the vacation rentals that we just spoke of. So that's a great way to get first right refusal and stay in the know on great passive income options that are available to you. And then also we have our investor quiz. If you're not sure what type of passive income investment is best for you, are you a single family rental person? Are you a private lending person? You like a little bit less risk, a lot more passive experience, then private lending could be the perfect option for you. Or are you somebody that's retired or on the cusp of retirement and you love the idea of being able to use your property down in the Caribbean, and when you're not, you make some money on it. So take that passive income quiz, find out what type of investor you are. Maybe you're 1 or 2 of the other 3, maybe you're all 3. Find out by taking that quiz. So once again, thank you all for listening to us. This is another episode of the Real Estate Cowboys, and we'll see you next week. Thanks.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.